Amazon 25B bonds warning. Is your capital strategy broken?
I mean, when a company that effectively prints money suddenly has to, sweeten the pot just to get a loan, well, every single executive and board member out there should probably pause to reevaluate their playbook.
Yeah, we are absolutely looking at a fundamental repricing of risk happening in real time. So welcome to this special Strategic Business Advisory Deep Dive presented by L Impact Solutions.
Thanks for having me. It's a critical topic today.
It really is. Our mission for today is unpacking a really comprehensive analysis from L Impact Solutions. This was published recently on July 18th, 2026 by Dr. M. Lokesh Hari.
Right, and it covers a massive structural shift happening right now in how credit markets are treating AI investments.
Exactly, because we said the last, 3 years watching companies just throw blank checks at AI infrastructure.
Right, for sure. Just unlimited capital.
Right. But based on what just happened in the corporate bond market, that era of unquestioned capital might be slamming shut. I mean, think about it. When one of the wealthiest companies on earth suddenly has to pay a premium to borrow money, that's a massive canary in the coal mine for your own business's capital strategy.
It really is, because the credit market, it's essentially the nervous system of the global economy, right? Like equities and stock markets, they run on sentiment and narrative.
The hype cycle.
Exactly, the hype cycle, future promises. But the bond market, that runs on cold, hard math.
Yeah.
And when the bond market twitches, it means the underlying math of these massive tech investments is being heavily, heavily scrutinized.
Well, let's get into the mechanics of that twitch, right? To really understand how to fix a capital strategy, we first need to look at the exact market event that exposed the cracks. So on July 7th, Amazon went to the market to sell $25 billion in bonds.
A huge offering.
It's massive. And to put this in perspective for anyone who isn't, glued to corporate treasury movements, Amazon has an ironclad investment grade rating. They pull in over $650 billion in annual revenue.
They're a fortress.
Right. A total fortress. Yet, to successfully offload that $25 billion in debt, they actually had to offer an extra 18 to 21 basis points in yield to attract buyers. So help us translate that. In the world of institutional finance, what does an extra 20 basis points actually mean on a deal this size?
Yeah, so a basis point is simply 1/100th of a percentage point.
Okay.
So 20 basis points is just 0.2%, which, it sounds totally negligible if you are talking about like a personal car loan.
Right, I wouldn't even notice that on a mortgage.
Exactly.
Yeah.
But when you apply that to a $25 billion principal, you are suddenly talking about an extra $50 million a year in pure interest payments.
Wow. Just $50 million extra, just like that.
Just like that. Amazon had to commit tens of millions of dollars in extra yield simply to convince institutional investors to take their paper.
Which implies those institutions saw something that made them demand a higher premium for the risk, right? Mm-hmm. And it wasn't just the price that shifted. I mean, the analysis highlights that the actual appetite dropped. Investor demand fell to 2.5 times the offering.
Yeah, that drop in demand is key.
And just for context, for those outside the bond syndication world, an order book at 2.5 times means that for every dollar Amazon wanted to borrow, investors offered $2.50. Which, that sounds healthy, doesn't it?
It sounds oversubscribed, yeah.
Right, but context is everything here. Because just a few months back in March, their demand was at 3.2 times the offering.
And the velocity of that drop is exactly what institutional investors are flagging, going from 3.2 to 2.5 in just a matter of months for one of the most secure companies in the world. That is a material cooling of demand.
Yeah, that's a big shift.
According to the L Impact Solutions data, this was actually the weakest demand among any recent hyperscaler bond offering.
The weakest?
Yeah. And we really need to look at the macro volume to understand why lenders are getting so exhausted. Because Amazon hasn't just borrowed $25 billion. Their total debt issuance hit $92 billion this year alone.
$92 billion.
Right.
In 1 year. And they are just one piece of this colossal pie, right?
Yeah.
The broader corporate AI bond surge has reached $270 billion.
Which is nearly double the previous year.
Right. It was like $136 billion the year before. And out of that $270 billion, the hyperscalers, so Amazon, Microsoft, Alphabet, Meta, they count for $194 billion of it.
It's just a historic amount of debt being funneled into a single technology segment.
It really is. It's like having a pristine 800 credit score, right?
Right.
But when you go to the bank for a loan, they suddenly demand a higher interest rate and extra collateral. Something in the lender's perception of your risk has fundamentally changed.
That's a perfect analogy. The lenders aren't saying Amazon is going to default, Capital markets don't reject leading companies outright.
Right. They just tighten the screws.
Exactly. They just gradually tighten the screws by demanding higher yields and, crucially, proof of execution. They're saying that Amazon's specific exposure to AI infrastructure costs is just accelerating so fast and the debt load is getting so heavy that the baseline risk profile has elevated.
So it's an early market stress indicator.
Precisely. As Impact Solutions points out, this isn't an isolated financing hiccup. The market is drawing a hard line.
So they aren't willing to fund the narrative at a discount anymore.
No. They want to see the pathway to commercial returns.
Well, if the credit markets are demanding to see the math, we should probably look at the actual numbers driving this infrastructure race. Because the gap between what is being spent and what is coming back in commercial revenue is, frankly, staggering.
It is.
Hyperscalers like Microsoft's Alphabet, Amazon, Meta, Oracle, they're planning over $320 billion in annual AI capex.
$320 billion. Just let that sink in.
Yeah. And meanwhile, NVIDIA is pulling in over $40 billion in quarterly data center revenues alone. The physical infrastructure is being built at a scale that is just hard to comprehend.
And the physical reality of AI is really what separates it from, say, the cloud computing boom 10 years ago.
Oh, how so?
Well, when a company transitioned to the cloud, it was largely a software shift, right? Generative AI requires fundamentally different, vastly more expensive physical hardware. It requires specialized data centers, advanced networking, new cooling systems.
Right. They consume exponentially more electricity.
Exactly. You are laying out hundreds of billions of dollars in hard physical assets. But here is the structural flaw that the Impact Solutions report highlights. Enterprise AI adoption is wildly uneven.
Meaning the infrastructure is being built much faster than organizations can actually commercialize the applications.
Exactly. Companies are buying the enterprise AI software, sure, but they are really struggling to integrate it into their actual workflows to generate measurable productivity gains.
Right. They aren't seeing the ROI yet.
No, the end user isn't generating the massive profits required to pay the hyperscalers, who in turn need to pay back the bondholders.
And this creates what the advisory report terms capital concentration risk. Because if the entire global supply chain is currently being propped up by that $320 billion in hyperscaler spending, a pullback would be devastating.
It would crush suppliers.
Right. We're talking about semiconductors, copper miners, renewable energy, fiber connectivity. If the tech giants slow their capex by just 10 to 15%, the ripple effects would be massive.
You would see immediate and severe earnings volatility. Suppliers exposed to that spending would face sudden drops in utilization rates.
Massive inventory gluts.
Exactly. We are in a fragile ecosystem where the global economy is highly dependent on a few companies continually increasing their debt to buy GPUs.
Okay, but wait, let me push back on this whole premise for a second.
Yeah.
If you sit on the board of one of these tech giants, you know that AI is a paradigm-shifting revolution. It is the undeniable future.
Nobody's arguing that it isn't.
Right, so why are investors suddenly getting cold feet and demanding immediate returns on something that is clearly a long-term technological revolution? Why shouldn't executives just ignore the impatience and build for the future?
That's a fair question, but here's the thing. Investors are no longer doubting AI's potential. What they are doubting is the financial math.
The math.
Yes, the sheer velocity and scale of the cash burn is just fundamentally different this time. They want to know if hundreds of billions in spending can actually produce acceptable cash flow and return on invested capital, or ROIC, within a reasonable timeline. If you borrow $25 billion at a high interest rate, your AI product doesn't just need to be cool. It needs to generate a cash yield significantly higher than your cost of capital just to break even.
So it's not a crisis of belief in the technology. It's a crisis of the timeline and the math.
Precisely.
Which leads directly into the diagnosis of why this is happening.
Right.
Because if the financial math is getting shaky, how are corporate executives justifying these massive budgets to their boards and investors?
They are basically using the hype cycle as a shield against governance.
Wow.
Yeah. The Impact Solutions analysis points out a really critical weakness in corporate governance right now. Executives are announcing multi-billion-dollar AI investments without publishing basic financial safeguards.
Like what kind of safeguards?
We're talking no measurable return thresholds, no capital allocation scorecards, and absolutely no downside scenario planning.
That's genuinely baffling. So executives are essentially just riding the hype wave without a seatbelt.
Ah,
I mean, how do you even put a hard ROI on something as experimental and rapidly changing as AI integration?
well, you have to. Addressing that exact point, relying solely on a, long-term innovation narrative is just no longer acceptable to institutional investors.
They want specifics.
Exactly. They expect to see how investments will specifically improve operating margins, free cash flow, and customer lifetime value.
But the boards are just rubber stamping these projects anyway.
Mostly, yes. And operating without those guardrails in the current macro environment is highly negligent because look at the macroeconomic headwinds we have right now.
Right. Global interest rates are still way above pre-pandemic averages.
Exactly. And government borrowing is expanding, which sucks liquidity out of the system. Plus, corporate refinancing costs are elevated.
So it's a terrible time to be borrowing blindly.
It really is. And that's L-Impact Solutions' key observation here. The market is transitioning. It used to reward ambitious AI narratives and massive spending. Now, it only rewards disciplined AI execution and transparent governance.
Okay, so now that we've diagnosed the problem, which is, an expensive infrastructure race combined with poor governance and tight credit markets, what is the actual solution for your business?
Right, we need a remedy.
Exactly. And L-Impact Solutions provides a highly specific blueprint for AI capital discipline. The first recommendation is a massive shift, moving to a stage-gated funding model.
Yeah, this borrows heavily from venture capital and pharmaceutical development.
So instead of a board approving a $2 billion AI rollout on day one, projects have to progress from proof of concept to commercial rollout.
Yes, you only unlock funding when predefined milestones are met.
The report gives some really concrete examples of this, like a team shouldn't get more funding unless they can prove the AI model achieves, say, 95% accuracy.
Or 20% productivity improvement.
Right, or a 15% cost reduction.
Yeah.
So essentially, L-Impact Solutions is telling businesses to stop treating AI like a blank check and start treating it like a venture capital funding round. You only get the Series B money if you actually hit your KPIs from Series A.
That is the perfect way to look at it, because that structure prevents stranded assets.
Oh, right, because the tech evolves so fast.
Exactly. If you buy all your hardware up front before you even figured out your commercial use case, you risk holding billions of dollars of depreciating, obsolete tech.
Makes total sense. The blueprint also demands strict overarching financial resilience. They recommend companies maintain conservative leverage.
Specifically, keeping the net debt-to-EBITDA ratio below 2.5x.
And keeping the interest coverage above 8x, right? Plus keeping 12 to 18 months of liquidity on hand. Why are these specific metrics so vital right now?
Because flexibility is everything in a volatile credit market. If AI adoption is slower than expected, a company with an interest coverage ratio of 8x can weather the storm without having to fire sale assets.
They have a buffer.
Exactly, which ties directly into the board's responsibility to conduct scenario planning. Boards must stress test for downside cases.
Like what? What kind of downside cases are we talking about?
Well, the report suggests things like 20% slower AI adoption, or 15% semiconductor inflation, or even 25% electricity price volatility.
Wow, yeah, electricity costs for these data centers are no joke.
Right. And if the board hasn't asked those questions, they aren't governing. But the only way to ensure executives actually adhere to these discipline frameworks is executive compensation.
Yes, this is a big one. The blueprint advises linking 25% to 40% of executive long-term incentives directly to measurable AI outcomes.
Not just the volume of technology deployed.
Right, to actual outcomes like margin expansion and cash flow.
And that proactive, transparent communication with investors about these exact metrics, utilization rates, productivity gains, projected revenue timelines, that is what narrows credit spreads.
It secures lower financing costs.
Absolutely.
So let's distill all of this into a final takeaway for the listener. The days of capital markets rewarding AI scale and ambition alone are over.
They're completely gone.
The next competitive advantage belongs to leaders who use L-Impact Solutions frameworks to demonstrate disciplined governance, high ROIC, and measurable commercial execution.
Execution is the name of the game now.
It really is.
Yeah.
Which leaves us with a final lingering question to ponder on your own. As the global economy becomes incredibly dependent on a handful of hyperscalers for AI infrastructure, what happens to global innovation if credit markets force those specific giants to drastically scale back?
It's a scary thought.
Could the next major technological breakthrough be delayed simply because of a bond yield?
It really shows you who holds the levers.
It really does. For more strategic analyses, visit our website link in the description below.